Hello, I'm Lora Painter. Tax season is here, and over the next half hour, we're going to talk about advice to save you time and money when it comes to filing. First off, a new free tool to file your taxes for free in California is back. IRS Direct File is now in its sophomore year with new features and more eligibility. I talk with an expert about what you need to know to file your taxes for free directly with the government.
Filing your taxes is a civic duty, and you shouldn't have to pay a fee to do it.
And so the IRS launched Direct File. It's a program where you can go online, file your taxes directly with the IRS for free. It was in pilot in 2024, and now it's back. Its reach has more than doubled now to 25 states, making more than 32 million Americans eligible.
It's expanded. There are some new features that make it even easier for you to file your taxes with the IRS instead of having to pay a private preparer.
The Treasury Department estimates users saved nearly $6 million in tax preparation fees during the pilot period. The Groundwork Collaborative says the program now covers a wider range of tax situations and offers advanced new functionality to pre-populate some taxpayer data, making filing even easier and faster.
If you start with Direct File, you can check your eligibility very quickly. And if you're eligible, you can just go right ahead and file your taxes.
Research from the Economic Security Project shows this IRS Direct File program has the potential to save taxpayers $11 billion annually in cost and time savings. At this time, the IRS says you cannot use Direct File if you have income from the gig economy or rental or business income. Qualifying income includes W-2 wage income, Social Security income, and retirement income.
I've been doing some reading on this, and some folks have said that this is a game changer. How so?
Just being able to do this for free is really important for taxpayers. Also, being able to do it directly with the IRS, know that your information is not being sold to other companies, not being used to market to you, but instead you're just interacting with the government to pay your taxes for free and get your refund back, I think is a game changer for a lot of families.
And remember, the deadline to file your taxes is April 15th, but Direct File will be available until October 15th for people who have additional time to file. 25 states, including California, are participating in this free tax filing program. We have eligibility details and a link to file on our website, ABC10.com. There are other websites where you can file your federal income taxes for free if your income is less than $84,000 a year, like Free File. It's a partnership between the IRS and tax software companies that lets you use the software for free. However, you must click through the IRS's website to get the fees waived. Senior citizens can use free programs from AARP or the IRS to do their taxes, and Cash App Taxes allows many people to use their software for free. We've heard from several viewers asking if President Trump is making major tax changes. They're concerned he's changing how people can claim dependents in child support cases. Adiande Till with the Verified team is getting answers.
Several viral TikTok videos with millions of views claim President Trump announced a new law that would change how child support recipients claim dependents on their taxes.
Trump passed a new law that whoever is paying the child support will get to declare those children on their taxes.
Many of these claims say Trump posted about the new law on social media.
Oh my God, Trump just tweeted, if you put your baby daddy on child support, that the baby daddy now gets all of the income tax.
But are those claims true? Let's verify using these sources. According to the IRS, only one person can claim tax benefits for a dependent child per year. Generally, the custodial parent, the parent with whom the child lived with the majority of the year, claims the dependent. If the child lived with each parent equally, the custodial parent is determined as the one with the higher adjusted gross income. President Trump hasn't changed any of that. We checked Trump's social media accounts and examined his policy platform known as Agenda 47 and found no mention of proposed changes to the federal child support tax law as the viral claims suggest. But even if he had, implementing those changes would not be as straightforward as announcing it on social media or even signing an executive order. Amending the tax code requires Congress to pass a bill modifying federal tax law. That hasn't happened, nor has it been proposed. With your Verify, I'm Adiande Till.
Your refund could be delayed because of cuts to the IRS. The Internal Revenue Service is bracing for layoffs of at least 10,000 people right in the middle of tax season. Probationary workers face layoffs as early as next week. Keep in mind, the IRS handles more than 100 million tax returns each year. But what if you miss it or don't file? Casey Decker with our verified team tells us what could happen.
The deadline to file your taxes is April 15th, and some of our viewers wondered what would happen if they didn't file their taxes or filed them late. So let's verify. Is there a penalty for not filing your taxes on time? Our sources are the IRS, H&R Block, and TurboTax. The answer depends on whether you owe the IRS money. If you owe any taxes and fail to pay that money on time, the IRS will begin to charge you penalties. Every month, those penalties continue to rack up, and you're also charged interest on top. Then, if you not only fail to pay on time, but also fail to file your return on time, they charge an additional penalty, which also grows over time and also accumulates interest. And if you owe state taxes, your state might charge you similar penalties as well. So yes, there are penalties for not filing your taxes on time. But what if you don't owe money to the IRS? What if you're due a refund? In that case, there is no penalty for not filing, at least not from the IRS. But if you don't file, you can't get that refund, so it's sort of a self-imposed penalty. With your Verify, I'm Casey Decker.
During this tax season, we're helping an ABC10 viewer. She says she wasn't getting the help she needed when she hit a roadblock filing her return online, with hopes of getting her refund fast.
I was getting nowhere for 2 weeks until you guys got involved.
What started as a hopeful and routine tax filing for viewer Juliana Pierre-Bell turned into hours on the phone, numerous emails, and virtual chats with tech support.
And I just kept getting transferred and transferred and transferred, and no one had a solution. And I was just like, in Italian, it's finito. I'm done.
Juliana tells me she files her taxes with TurboTax every year, but this year, for the first time, decided to jump on a promotion called TurboTax Refund Advance.
This year, they partnered with Credit Karma, and they came out with an instant refund up to $4,000 of your return. I thought, well, that's great. I don't have to wait the 3 weeks to get the money. So I started the process.
These are screenshots she sent us of error messages she says showed up at the end of her tax filing process online.
And I would get all the way through, put my social security number in, put all the information they were asking me, employment, and then it would go, oops, something on our end.
Juliana says she contacted customer support and followed their troubleshooting suggestions, but says she kept getting error messages.
Describe for us what you were feeling hitting these roadblocks and not getting any satisfaction from the companies involved.
Well, being in sales, I'm a problem solver. So I was getting frustrated with myself because it was like, what am I doing wrong?
Just hours after I talked with Juliana and emailed TurboTax's parent company Intuit, they wrote back and called Juliana. Several emails, progress updates, and a technician chat later, Intuit determined Juliana did not qualify for the promotion. A spokesperson sent ABC10 a statement, saying in part, quote, "At Intuit, we prioritize customer satisfaction. In response to this customer's inquiry, we promptly worked to investigate the issues and assist in resolving it. Ultimately, the customer was not eligible for the loan product, and we were unable to offer them a refund advance loan." Juliana says Intuit filed her taxes, refunded her the $277 filing fee, and now she's waiting for her tax refund from the IRS, just not as quickly as she had hoped at the start.
Well, I just thought it was amazing that I got a phone call back, because you just never know what's going to happen, because I'd never done this before. And to get such a pleasant voice as yours and really help me, and you really took this as your own, and that's hard to find in people these days. You really own it. And kudos to you for being such a good-hearted person. And I really appreciate it. Don't make me cry.
Financial coach Maureen Paley warns to take extra precaution before jumping onto any tax season promotions.
Tax season, it's a busy time. Any advice for people who may be using a similar tax preparation program?
Make sure that you know the terms. Make sure that you go in eyes wide open, because at the end of the day, that is a financial agreement. That's a financial contract.
Paley recommends reading the fine print, calling customer service, and asking questions before you sign an agreement.
Say, tell me what this is, just like plain and simple, so I really understand what I'm getting into. We all have the right to do that as consumers, and it can really help us make the right decision.
You can also look at the Better Business Bureau website if you're looking for complaints and reviews. In more dollars and cents, even if you've already filed your taxes this year, it's not too early to start planning ahead for next year. I talked with a Sacramento-based financial planner about small adjustments you can make now to save money, reduce your tax burden, and set the stage for a financially bright future. What are some moves people should make to make filing next year a little easier?
There's a number of considerations involved with proactive tax planning.
Joseph Eshelman, president of TowerPoint Wealth, says tax brackets at the federal level are still historically low, so you might consider accelerating income.
Which means paying more in income tax.
Not everyone has the ability to do this, but if you have certain investments, Eshelman says it may be worth your while to pay a little more tax now while rates are low. You might also consider a Roth IRA conversion.
Convert dollars that you have in an IRA account to a Roth IRA account. And the benefit of considering doing what we call a Roth conversion is once you get that money in your Roth IRA, it grows tax-free and it comes out tax-free.
Eshelman warns you could owe income taxes on the amount you convert, but 2025 could be a good time to pay the tax now during historically low rates. When it comes to investments, losses aren't always such a bad thing. Consider what's called tax loss harvesting.
If you have an investment that's declined in value, sometimes it makes sense to sell it because you own that investment at a loss.
Eshelman says you can use the losses to offset taxable gains from other investments. He says if your total realized losses are more than your realized gains, you can offset up to $3,000 in ordinary income annually.
A lot of times, Laura, people only look to do tax loss harvesting at the end of the year.
Oh, really?
When they're starting to come up against the December 31st calendar year deadline. But in our opinion at TowerPoint, it makes sense to consider loss harvesting and looking for these opportunities throughout the year rather than just waiting until November or December.
Eshelman also says not all investments are equal when it comes to taxes. This is where asset location comes in. It means putting investments in accounts that offer the most favorable tax treatment.
So when we talk about locating certain investments in certain accounts, what we'll do with our clients is if they own an investment that pays out a lot of regular, ordinary interest and income, which again we like, but it's tax problematic, we'll own those what we call tax inefficient investments inside their retirement account only.
That makes so much sense. Thank you so much. So doing some investigative work through the numbers and your accounts can really pay off.
Yep.
Remember, everyone's situation is unique, so talk with a financial advisor or tax expert to find the best tax-saving plan for you.
You'll also want to prepare for the Tax Cuts and Jobs Act potentially expiring. It's a 2017 law that more than doubled the standard deduction and child tax credit, among other things. If it expires at the end of this year, it could make a big difference to your wallet and your taxes. I break that down in detail for you in another Dollars and Cents story coming up in just a moment. In this Dollars and Cents streaming special, big changes could be coming to your taxes. 2025 is a pivotal year for tax policy, with the 2017 tax law set to expire by the end of the year if Congress doesn't keep it in place. So what's at stake and what can you do now to prepare?
A major federal income tax overhaul.
The Tax Cuts and Jobs Act, passed by Congress in 2017 under the first Trump administration, substantially changed federal tax deductions, rates, and credits. It's set to expire at the end of this year unless Congress steps in to extend it.
Should this expire, what are the consequences for federal taxes?
For starters, the Tax Cuts and Jobs Act reduced all of the major federal tax brackets. So if the TCJA does in fact expire, singular immediate consequences, you're going to be subject to higher percentage tax rates than what you have been over the past 8 or 9 years.
So we know since 2017, single filers and joint filing taxpayers have really enjoyed the benefits of a higher standard deduction, which, thanks to the act, had more than doubled.
Yeah.
Break down for us, Joseph, what viewers can expect as far as changes if Congress doesn't act and step in. What are the costs to taxpayers here?
Sometimes people itemize on their tax return rather than taking the standard deduction. So if that standard deduction does in fact drop, which it is set to drop significantly if the Tax Cuts and Jobs Act expires, it's going to mean a higher tax bill for a lot of Americans who are taking the standard deduction, just because they're not going to be able to take as large of a standard deduction as what was previously the case under the TC&JA.
Joseph Eshelman, the president of Tower Point Wealth, also says should the act expire, there may be more opportunities for itemizations and deductions, such as charitable donations, that weren't available while the act was in place. If you use the child tax credit, which doubled under the Tax Cuts and Jobs Act from $1,000 to $2,000 per child, Eshelman says taxpayers could expect that credit to return to $1,000 should the act expire. A lot of families who have children, they really rely on that because the cost of childcare is so expensive. This could be detrimental, like you said, to middle-class families.
Yeah, there's no question about that. And and when they double the credit, with the passage of the act in 2017, it was huge for a lot of families.
Experts say at this time it appears the likelihood of the act being extended is fairly strong. But a lot can change from now to the end of this year. We'll be monitoring it closely and keep you updated.
And if you file in California, also pay attention to the SALT deduction, which stands for state and local taxes. Right now, under the Tax Cuts and Jobs Act, the SALT deduction is capped at $10,000, which experts say isn't much for places like California. If the act expires, the SALT deduction cap would go away, and you may benefit from a higher deduction opportunity. So talk with your financial planner or tax advisor about what that means for you. Our dollars and cents coverage continues now. Americans are drowning in credit card debt. Now there's a new push in Congress to cap credit card interest rates at 10%. An expert I talked with says if this becomes a reality, it could be life-changing for millions of people.
This would set families free.
Americans are drowning in credit card debt, averaging more than $1 trillion total, according to the Federal Reserve Bank of New York.
Credit card debt is the highest that it's ever been in the United States.
Financial coach Maureen Paley says high interest rates are making tackling that debt even harder. As I've reported in prior dollars and cents coverage, some credit card companies are charging more than 35%.
There are plenty of consumer advocates saying that these interest rates are too high.
That's why there's a new bipartisan push in Congress led by Democrat Senator Bernie Sanders of Vermont and Republican Senator Josh Hawley of Missouri.
The difference between a 29.99% APR and a 10% APR is huge. Thousands and thousands of dollars. Years of being indebted can be wiped away. This would be a huge gain for consumers.
Paley says, keep in mind, different credit cards work in different ways. Some have a fixed annual percentage rate, meaning an interest rate that doesn't change over the life of the loan, while others have a variable annual percentage rate, which means the rate can change over time. Paley says when the Federal Reserve raised rates, that also raised the interest rate for people with variable APR credit cards.
For some of us who may have gone into that credit card agreement several years ago when rates were low, when the Federal Reserve raised them, it was like sticker shock when you got your bill.
Paley also says inflation plays a role in how people use their credit cards.
In an inflationary environment, the $100 I use at the grocery store, when I go to the grocery store, all of a sudden I can't get all the items I used to get with that $100. So folks have been relying on credit cards, to make up for that shortfall.
As a result, Paley says people's credit card balances are growing and debt is lingering. Do you have any advice for viewers to help them manage their credit card debt?
Look at all the specifics around the debt. So you want to list the credit cards that you have. You want to identify what your balances are currently. You want to identify what the APR interest rate that you're paying is.
Remember, credit cards are a type of loan, and the interest is where card companies make money. Experts say you can avoid paying interest by stop using your credit cards altogether or by paying your credit card balance in full every month. You also might start with paying one card off first. You can also use an interest rate calculator to understand that debt amount is going to grow over time and to really see what's at stake with the purchases you make. Medical debt is a struggle for millions of Americans. Recent moves from a federal government watchdog to help people tackle it are up in the air right now. The Consumer Financial Protection Bureau issued new regulations at the start of this year, but the fate of that agency and its regulations are now uncertain. I talk with a Sacramento-based financial expert about what's at stake.
Supporters of the change have called it life-changing. How so?
Indeed, your credit report, is that report card that shows financial institutions, lenders, anyone that's going to give you money. This is why it's your report card to prove I'm good for it.
Credit reports are critical to financing many aspects of American life, like owning a home, a car, or starting a business. But for the millions of Americans with medical debt, reaching those goals could be harder.
Medical debt has been getting in the way of folks getting approved for financing, either completely or approved at reasonable terms.
In early January, during the final days of the Biden administration, the Consumer Financial Protection Bureau, a federal consumer watchdog, announced new regulations barring medical debt from credit reports, set to take effect March 17th. But right now, the future of the Bureau and that new regulation is uncertain. After President Trump took office for his second term, the CFPB workforce in February was ordered to stop working by Acting Director Russ Vought. Financial coach Maureen Paley says there's also concern this new rule could be reversed.
They can remove that order, which would, again, be a burden. We would bring the burden back to the consumers and the everyday Americans that incur this medical debt and have a hard time getting out of it. And it would benefit those organizations that benefit from folks being in those debts.
Paley also says medical debt is the cause of 60% of bankruptcies. This new regulation could open new doors to people struggling with medical debt. The change is estimated to raise credit scores by an average of 20 points or so for millions of Americans. Put that in perspective for us. What impacts could 20 points have?
20 points can save you tens of thousands of dollars. A 20-point difference on your credit score could be the difference between you getting financing at an exorbitant high interest cost or one at a more moderate interest cost. It could also be the difference between you getting approved at all.
For now, the CFPB website is back up and running after a brief shutdown last month that coincided with the stop work order. And the consumer complaint database is still online, but there may be no one available to take those complaints or to help. Do you have any advice for people on how to manage their medical debt?
One thing that I would suggest is call the entity that's issuing the debt and understand, number one, where it came from.
Get the details of the charge and call the provider for charity care to try to get the debt reduced. You can also ask them to negotiate the debt.
We'll be watching all of this closely. Now keep in mind, Californians' credit reports are safe from most medical debt, thanks to a new law signed by Governor Gavin Newsom last year. Thank you so much for joining us. I'm Lora Painter. See you next time.